Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Tuesday. It's June 14th. Where is the summer going, right? I'm still waiting for last summer. This is crazy. Time just gets away from me. Really, time. You could tell me it's December right now. And here's the thing. I'm in Florida, so it's always warm. You could literally fool me on the time of year. I'm so bad with dates and time of year. It's ridiculous. Anyhow, folks, if you're getting some benefit, if I'm calming your worries, your fears, send me a love letter. I love getting them. T-Buzz gets love letters. He talks about them all the time. I want to get them too. Support@marketgeeks.com. Or if you don't have the time, just post some comments below this video in the YouTube channel. Either way, I want to hear from you. I want to know if I'm helping you, or at least helping you survive in this crazy, crazy market. So let's get into today's comments, news, and editorial. So NASDAQ is up a little bit. Dow futures are up barely, up 33 points. S&P's up 8. Not really a big factor right now because the volatility has just been so high. If you look at the Dow the last few days, just to give you a little idea of what we've been going through, this is craziness. It looks like price is just being spit out here. The positive news is RSI is way overdone. And as you can see here, it doesn't happen often. And whenever it does, markets typically rally. So we are, in fact, due for a rally over the next few sessions. That I could tell you with not a 100% certainty, but about an 80% certainty. At least over the next few days, I think these gaps may get filled. The markets, this is too much too soon. From 33,000 all the way to 30,000, 1,000 points a day. That's just too much. The reason it's happening is because the CPI last week was crap, and then consumer sentiment came out, and that was even worse on top of it, which is fearful, making investors fearful that we may in fact be going into a recession, which I think if we are, it's going to be a very mild one, a very shallow one, which is what I've been saying, mild pullbacks. The bond market broke its low, but it looks like it wants to go back into its range. It'll be very interesting if we stay here or if that was in fact the low, because if that was in fact the low, there's a huge correlation between bond prices and the stock market over the last several months. As you can see here, we started going down in December, and if you look at the QQQ, which is the sector that's mostly impacted by this, it started going down in November, about 3 weeks before. And as you can see here, see how it broke the low? The correlation is uncanny. But again, it doesn't look like the bond market has a lot more downside to go. But again, the correlation is huge. The problem is, I think the majority, 90%, 80 to 90% of the downside is priced into the market. One of the factors that we want to take a look at to show that is momentum studies. And you look at momentum studies, I just want to show you the number of stocks in the NASDAQ 100 trading below the 200-day moving average. You got to see this. Let's go on a 20-year chart. Look at where we're at, folks. We're at 2008 levels right now. So if you think the market's going to go much lower, it's not. It's like a rubber band that's been stretched out again, and then stretched out again like that right now. So yeah, we may go down another 1,000 points, another 500, but we're close to the bottom. My point is, we're not up here. We're down here right now. And if you look, this is the 200-day moving average. This is the big daddy. If you look at shorter term momentum levels, we're not doing any better. So short term, look at where we're at now. Folks, I'm not kidding right now. This is the weakest momentum level in the NASDAQ in the last 20 years. In the last 20 years. We have not had, look at this. I'm not kidding. Just look at it yourself. Look at that. We've never been this low. Let me show you. Look. Barely here in 2010, barely for like a day, right? But let's see here. The low here is about 5. The low here is 6. No, we're lower right now. So we are at the lowest level on the NASDAQ 100 in 20 years and probably longer. But this is as far back as it goes. So if you're expecting a market to crash from here or to really bear out, I've got news for you. It ain't going to happen. Here's another sign. Notice the market. Notice the Dow Jones made a new low yesterday. Wait 1 second. Sorry. Broke down, made a new low, right? Lower low. Right here. Let me show you a few signs here. And there, you see that little circle? That means it's a swing low. So Lower low, right? You could see here it's a lower low. But look at the Russell 2000. Did not make a lower low. Prices are actually, let's see here. The low here is 168.90. The low here is 169.29. So look at the low, 168.90, 169.29. We didn't break the low. That's huge. Here's another major factor. Look at volatility. Lower highs. Market, the Dow Jones is breaking lows, lower highs. Very, 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 very significant. And put the call ratio, look at where it is right now, 130. So there's several factors that are saying that at least this swing is done for it. And I don't think we're going to be going down much lower. So this is a good time to start buying stocks. I'm not kidding. This is a good time to start buying stocks. Now, let's talk a little bit about global economy. Shares traded down in Europe are racing brief gains after the market opened, while Asian shares fell but later recovered. Tuesday's market action, S&P lost 3.9%. We're now at 21.8% below its peak, which means we are officially in a bear market. We're down more than 20%. But again, I don't really see a lot more downside. At the center of the sell-off is the U.S. Federal Reserve's effort to control inflation by raising rates, the war in Ukraine sending oil and food prices sharply higher, fueling inflation and sapping consumer spending, especially in Europe, which is a big factor. Some economists are speculating that the Fed may raise its key interest rates by 0.75 of a point when it meets on Wednesday. That would be the triple amount they would raise. I don't know if that's priced into the market, but because we're talking about it right now, it probably is priced into the market already, or at least a good percentage of it. Apart from the jitters over inflation and what central banks are doing to temper surging prices, restrictions to curb the spread of COVID in China has also weighted on sentiment. And what if COVID returns in the U.S. again? Oy vey. Markets are bracing for more bigger than usual hikes on top of some discouraging signals about the economy, corporate profits, record low preliminary readings on consumer sentiment, soured by high gas prices. It's just a mess. And that's usually how it is. But again, remember, markets are forward looking and they price all this in. The risk is central banks could cause a recession if they raise rates too high or too quickly. It's a balancing act. And last month, the Fed signaled additional rate increases of double the usual amount are likely coming. Consumer prices in the U.S. are at the highest level in 4 decades, rose 8.6% compared to a year ago, which is crazy. And one of the most reliable warning signals for an economic recession has been a short-term U.S. Treasury briefly yielding higher than longer ones. But again, that doesn't usually signal a recession for quite some time. And even if we do have a recession, I think it's going to be a mild one. Again, one of the biggest factors that I'm looking at right now, folks, is momentum levels. And when you see the number of stocks in the NASDAQ at 6% above 50-day moving average, the lowest level in 20 years, and 8, it's telling us we've had enough. And if you look at the composite, if you look at the entire thing, let's see how far this goes. Oh, this only goes down to, it doesn't go that far. It doesn't go that far. The NASDAQ 100 goes far, but this one doesn't. But look at the S&P. I just want to show you the S&P here. I mean, look at this. Look at this. This is 2008 right here. Right here. Look at where we're at right now, folks. Where do you think we're going to go? We're not here. We're down here. Not much more to go. Yes, we could stay around here. We could fluctuate a little bit. We can huff and puff, but this downside is done. Small caps are outperforming the large caps. Volatility can't make a higher high when we're breaking lows on the stock market. That's significant. And most of the news is priced in. Now, today is Tuesday. And Tuesday we focus on the strongest sector and the weakest sector. Now, nothing has changed since January. Energy and utilities and consumer staples. Stick with energy and consumer staples for now. To the downside, you got communication services and consumer discretionary. Looking at everything individually, the energy sector looks like it's had enough. Utilities, look at this. This is crazy right here. This is crazy. And by the way, utilities selling off is a bullish sign for the market. Consumer staples looks like it has a double bottom in place. Basic materials looks like they're done. Financials looks like they're done. Real estate looks like it's done. Industrial looks like it's done. And notice most of these are breaking the lows. But notice small caps are not. And notice consumer discretionary starting to hold on, while more speculative sectors are breaking down. Just notice that consumer discretionary did not break a lower low yesterday. That's another major factor. Major factor. Something that I didn't even pay attention to yesterday. This is why it's good to look at these things. Excuse me. Let me just look at the template here. Yeah, consumer discretionary did not break the low yesterday. Wow. The weakest sector did not break the low yesterday. That's very significant. And RSI is overdone. So you've got consumer discretionary not breaking lower. You've got volatility making lower highs. You've got the treasury bond really kind of starting to come back already into its range. And you've got put to call ratio at 130, and you have momentum levels lower than they were in 2008. So from where I'm sitting, I don't think the markets are going to go much lower. I think we're going to be gyrating around these levels, but I think we're going to be going higher instead of lower. I think this period right here, the next maybe 12 weeks, is going to signal the bottom, and we're going to start moving higher, because this is already the second part of this recessionary period, and usually markets are forward-looking. So I would say in about 3 months, we're probably going to start moving higher. And I think most of the COVID is going to be behind us, and we're going to get a good understanding of where inflationary pressure stands. We might be peaking out. Again, consumer discretionary stocks did not make a lower low. The bond market is moving back into its range. Small caps did not make a new low. Volatility is making lower highs. Put to call ratio is at 130, and momentum levels are at the lowest levels we've seen them in history. In history. Folks, that says a lot to me. Now, a lot of us have felt down in the dumps in the past few months. Heck, maybe even the past few years. I felt it too. With all these intense market conditions, it's hard to find that inspiration to get out of bed sometimes in the morning, let alone trade. But 6 months ago, I chose to ignore all the noise, and I set out on a mission. I wanted to bring my readers something brand new. I had a vision for an entirely new way to trade, one that doesn't require any sort of technical indicators or fundamental analysis, and it shocked me to the core. Folks, today at 1 p.m. Eastern Time, Tuesday, June 14th, this is the first time I'm doing this in 2 years. I'm dropping something new for you to see. This is a monumental moment in my life. I'm doing something new for the first time in 2 years. Click the link below. Get in on the list of the world premiere of my newest trading strategy. Bull market, bear market, I couldn't give a hoot. Follow the link below, and tomorrow I'm going to give you one long trade, one short trade. Follow the link below. Check out Pattern Trader. It's happening at 1 p.m. Eastern Time today. I'll talk to you guys soon, and remember, consumer discretionary, the weakest sector, didn't make a new low. Small caps did not make a new low. Volatility made a lower high. Put the call ratios at 130, and momentum levels are the lowest in history. Where do you think we're going to go from here?